Okay, good. Let me start the webinar. Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Today we are on Friday, 27th of November. Between 5 and 5:30 GMT, I'll try to review the forecast, what I have given it on 23rd, that is on Monday, the expected market moves for the entire week, 23rd to 27th of November. So I have given the session-wise forecast, all the three sessions of the day, Japanese, European, and the US session, how exactly the market is expected to make moves, either from the high to the low, low to the high, or breaching the high and go above, and things like that. Now it is a time for me to review the forecast, what I have given it. At the moment, you can see the live market quote page. The market moves are highly subdued. It is because of the holiday in US, Thanksgiving holidays. So the volume is relatively very low in the market. Because of that, the moves are not very effective. And also, most of the trades are coming from US. And in the absence of such trades, the players are not making any big way, either on the upside or on the downside of the market. But from the European session, slowly, because there are traders from other parts of the world, not all the traders are in US. The traders are there in Japan, Europe, Asia, etc. So those people will be participating and placing the orders, and slowly the volume will pick up. That is why you come across the spread between the high and the low is very, very nominal now, just about 10 to 15 pips in most of the currencies. So, which indicate that when the spread is less than 40 pips, it is not advisable to initiate trade. Let them just come closer to low or closer to high, then probably we'll think of taking positions. Meanwhile, I'll explain to you how exactly we are going to take up some trades later on. Before that, I will just review the forecast, what I have given it. And those of you who are interested in contacting me to get further details about this, probably you can make a note of my email ID, dr.dr@i-knowindices.com, and my Skype chat ID is iknowindices@hotmail.com. So in the event, if you like to contact and get some details, it's not a marketing thing, and just for your curiosity, if you want to know more, then probably you can contact me using these contact details, because many of the occasions I find people ask FX Street people to give the contact details. I was avoiding actually giving my contact details because I do not want to make use of this platform for marketing purpose. But later on, I find that some of the interested traders are not in a position to get the uh, required information. That is why I thought that I can display in my slide itself. So the actual trading system consists of three components, namely the derived forecast. So the derived forecast, I use a specific algorithm, which is nothing but a sequential statistical analysis, a derivation, by which I'll be in a position to give session-wise forecast. That is how exactly the market is expected to make an upward or a downward move, and on a daily basis, and for the week, month, year, multi-years, etc. And that is how the algorithm is deriving it. It is very similar how exactly we prepare our calendars for 2016. And we know what are the dates and what are the days in which those dates are going to fall, etc. Very similar to that, I'll be able to give the forecast for the entire year also. Then that particular forecast is fine-tuned because there is a gross forecast derivation. From there, we have to fine-tune it by doing the market reading, because you come across various influencing factors in the market, namely the volume, which is one of the biggest constraint or an advantage in the market. And if the volume is very low, the market can make very subdued moves. So when they make subdued moves, and you may find that the market is not moving in tandem with that of the expected market moves or the forecast. Because when the volume is not there, the players are not interested in making upward or a downward move. When they make upward or the downward move, they should be able to earn money from that of the market. But if no trader has placed an order, in what way they will be able to earn the money by making upward or the downward move? So basically you find that the market volume determines the momentum. Then besides, they can also make in the absence of the volume, but when the traders are anxious to know what is going to be the outcome of a data, say for example on Friday, they will be releasing non-farm payroll. So before that of the non-farm payroll, the traders will hesitate taking positions. So a similar condition, see what you come across now, because of Thanksgiving holiday, the market is having subdued moves. Very similarly, the market will be making a subdued move before the announcement of the non-farm payroll. At that time also, nobody will be venturing with the trade. They will not try to take a position and hold it, because we know very well the market shows whipsaw moves. So in that absence of the traders at that time, you do come across very big moves in the market. So the less volume condition or almost close to no volume condition, the players can make subdued moves or they can make big moves, because when they make big moves, they are not going to incur any loss, or they are not going to gain anything much. But they do such big moves in the less volume conditions, so that they need to sell only less quantity or buy only less quantity, and that they can easily do it. And so you find the market players take the advantage of such low volume in order to make whipsaw moves in the market before that of the data release. So you should be in a position to identify what the intention of the player is. So in order to fine tune the forecast, we do the market reading, and that market reading is nothing but identifying the intention of the players. Identifying the intentions of the player is the utmost important thing, because it is a man-made market. So in the man-made market, men trade against several traders. So a handful of men try to place orders and try to earn big using huge money power and try to trap the traders. So if the huge giant has to try to trap the other people, if they appear giant, then nobody will come for fight. So nobody will come for fight. So if a biggest bank give an open challenge, come on, euro, I'm going to take it to 1.10. If anybody is interested to push the market against me, you can do it. If they make an open challenge, nobody will push it, because they know very well they will not be able to earn anything on such bids. So what is the alternative? The bank has to keep silent, but they have to cunningly act against the traders. That is the only option. Even though I openly discuss in every webinar about the cunningness in which the players are creating the market sentiment and acting against that of the traders, they are not able to find an alternative method, because there is no alternative method available. If you want to earn money from that of the market without putting in an effort, the only option available is create a cunning condition. So a cowardice condition has to be created, and with which they will make the market appear bearish. Then the traders look into the charts and find, okay, our market is really bearish. So any small pull-up, you should be able to sell. That's what he mentally prepares. So they make small gain and drop, small gain and drop. So the traders find, Okay, yeah, it is a pullback. It is not similar to that of dead cat bounce back. How many times the dead cat bounce back? Nobody knows. But here in the market, very frequently, every session, the dead cat can bounce up and come down, bounce up and come down. Then the traders get that impression market is bearish. Sell and buy trade at the lowest level is really profit making. So they go in for increasing in the volume. So initially they take only one lot or a mini lot and try. Then when the going is good, it's very easy to earn money from that market. Why not I bet 10 lots? So that I'll be able to earn much more money when the market is really uncertain or the market is really bearish and there is nobody interested in pushing euro on the higher side. So when he develops the feel, immediately he bets more position beyond his capacity because of greed. So when the going is good, the traders turn greed. When the going is bad, the traders turn the traders turn um, panic. So when the greed and the panic act on the traders, what happens? They become confused, and in that process, they go in for a distress trade. So initially, when they find that they are able to easily make money when euro is coming to 1.06 or 07 and then come to 1.0600, then again going up and coming down, going up and coming down. So it's very easy to do a sell and buy trade. Then they take sells. Then they hesitate taking buy and sell because they find that in the event if it doesn't go up and drop further, they'll be losing money. So that is how they develop the bearish sentiment and start taking the sell and buy trade. Then in the process, what happens? The players gain the level up to that 1.0670, hold there and induce all the traders who had taken long positions to liquidate the long positions, and later on induce such traders to take sell positions if the traders find that they are very smart in making money from the other market, and then slowly gain further levels. So when they gain another 30-40 pips, then the traders think that no, I should do that averaging in order to earn back below that of the average, and they gain further up another 30-40 pips. Then they take further average by taking additional positions. Then the traders takes their decision, okay, let the market come down, I will stop at entry, I don't want any profit. That is what he thinks. So he keeps stop at entry. Then afterwards he find the market is going up further, then he become panic, then he becomes the extreme panic trader and buy it at the highest level for the weekend. So later on, he finds that he has taken a huge position. What he has earned in small trades as one lot, two lots, he has lost on Friday in all the lots, which he has taken the sell position as a big bet in the market. And finally, all are making huge loss and his account is wiped out drastically. So this is called the emotional trading. So whether you follow chart or not following chart, whether you follow fundamentals or not following fundamentals, if you become a emotional trader, you can never earn money from that of the market, because any emotional decision in this world, beyond doubt, they have been proved that they are wrong. So emotionally, some person probably attack another person and later on find the consequences are really threatening. Then he repents for it. So any emotional decision, it might appear correct at the given time, but later on when the emotion is subsided, you realize that you have done a wrong thing and you should not have done it. But as long as you are not able to realize it, you think that, okay, I have to control my emotion. Here afterwards, I should not become emotional like that. But when the quick moves happen in the market, immediately that triggers your emotions. And because of that, you find invariably you lose the patience. and become emotional and be driven by that of the market momentum. So what is important is reading the market, reading the intentions of the players. Always keep in mind the players make quick moves in the market mainly to trigger the emotions, mainly to trigger the emotions. And we call it as a spike. We also call it as a spike trade. We also think that is the greatest opportunity of making money. But predominant of the trade, predominant of the analysts say keep away from the market when the market is making the spike or a quick upward or a quick downward move, because that may erode your account, and that comes as a big surprise to that of the traders. So any surprise is known to trigger the emotion. We become stunned, and suppose you are walking along the road, somebody snatches your purse, immediately you become stunned to start with. And later on, many people might be telling you, and have you noted the face of the person who has snatched your purse? Have you taken a photograph of that particular person? Did you chase him? So all questions can be asked, but if you become stunned, nothing happens. Then later on, you do crisis management. You try to chase him, and you don't tell anybody. You simply ask for help from the people, and the people are not able to understand why you are running. So you find all distress conditions happen. By that, you don't get back the purse. So this is what happens in the market. So once you become distressed, you go in for a distress trade, and that becomes detrimental for you, because the players are not here to compel you to do the wrong trades, because only when you do wrong trades we lose money. We sell after the drop and buy back after that of the rise, then it becomes loss making money, loss making trade. Similarly, when they after the gain we go and buy, chase the market and buy, then later on the market drops, then you close the higher level buy at the lower level and incur loss. So these are all the two possible ways of losing money. So when you understand that you lose because you become emotional and buy after the rise, you want to be doubly cautious and want to buy after the rise, or you want to do a breakout trade after the market breaches the high and stay above, or breaches the resistance and the resistance turns support. Then you try to buy. But what happens after that such brief rise? The market does not make further rise. You anticipate a rise, but it is not happening. It drops and hit your stop. So if you use stop for any sort of trade decisions, you use all the statistics which are available in the market and try to trade following it strictly, or give it to an automatic trading system, putting in the input that okay, follow the MACD and do it, follow the parabolic curve and do the trades. You automate it and see. And also you go in for combinations of various such analysis and try to take positions. You find it might work for a few days, and later on it will incur huge loss for your account. Why? Because the market dynamics is changing. One. Why the market dynamics is changing? One, because the herd of traders continue to change their perceptions. So the predominant of the traders following technicals and fundamental analysis, they turn bullish and the bearish alternatively. What happens? The traders will be selling around 1.06 level in the case of euro. In a small pullback, they will try to sell and buy back against that of the buyback when they make a small slide. So you find that sell and buy trade is working well. Then later on, when the market suddenly jumps up, then immediately the trader covers that sell positions with a loss and start doing buy and sell trade at the higher level. This is what happens every time. Because in order to earn back the lost money, you start doing buy and sell trade. And if you ask a simple logic question, what you have been doing sell and buy trade at the lower level and buy and sell trade at the higher level. When it is become expensive, you wanted to buy. When it is cheap, you wanted to sell. Is it logical? So it is against logical, but it appears meaningful because you follow technicals. Then market appears based on simple moving average or pivot points or whatever it is. When this market is not able to breach the resistance and go above, immediately you say that it is bearish. So you have to decide on sell and buy trade. That is how you decide. So as long as the traders continue to do this sort of trades, the players are happily making money. You ask the platform providers in the world, in different countries, do you find any trader who is holding an account with you for the maximum number of years? If we ask them, they will say none, because the traders open the trading account, trade for a few occasions, few months, and later on they find invariably the account is closed, either by that of the wrong trades of the trader or his own. Otherwise, if you are really making money, the platform providers try to do some gimmick and try to do some trades against you and then close your account. So ultimately you find none of the traders consistently trade in a broking firm for several years, for the simple reason that the traders think that they can really make money, but they fail to understand their own mistake. Instead, they try to say that no, this platform is no good, and this platform provider or a broker is a cheat. So that is why I lost my account. Otherwise, I was really making sensible trade setups and I was really making money. That is what they used to say without understanding the mistake committed or the fault in their side. Such traders continue to accuse the platform provider or continue to accuse the market or simply say that the market is crazy, etc. And they feel brave. No, I wiped out 3 accounts. After that only I learnt about Forex. So they just say as if it is a real rewarding condition for an analyst. So it is something like a person is telling that, no, I purchased nearly about 7, 8 cars. I started learning driving using those cars and I smashed all those cars. And now I have become a perfect driver. If he says like that, nobody will hire him as a driver. Even his wife may not be able to travel with him because they will find that he does not mind crashing it. No, he learns it in a hard way by crashing the vehicle. How to apply brake, how to reduce the accelerator, etc. And he wants to learn it in a hard way. So if anybody learns trading in a hard way by closing accounts, he is not considered as an experienced trader. He is an emotional trader. He thinks that he is right in this world. The entire world is wrong against him and he is right. And without understanding his fault, he continued to lose money. And the players are very happy. No, when he loses money, the money is earned by the other players. So they say that, okay, follow technicals and fundamentals, because technicals and fundamentals will work very well if the market is not manipulated. But if the market is manipulated, then the players make the market appear following technicals and fundamentals and suddenly wipe out the market in a different direction and take away the money from the traders. That we need to understand. And nobody is frank enough to address this particular issue. And simply because about 10-15 years back, people were afraid of using the word market maker. And why? Because they said market is so huge and nobody will be able to manipulate. And I was explaining at that time that the market is manipulated with so many examples, but they simply say that no, market cannot be manipulated. And later on, they gradually accepted and found that none of the technical analysis on the basic conditions are working very well. So immediately they're going for modifications. A lot of people have gone for innovations with regard to technical analysis. And so in the name of technical analysis, what happened? So the platform providers and other websites, they just to take the raw data from that other feed coming from that other market and try to apply various conditions and just give various statistical analysis. And nobody has cross-checked. It is a very unfortunate situation. Nobody has cross-checked, because I had done, being a statistics professor, cross-checked some of the analysis which are done by that of the various websites. They are all absolutely wrong. And the parabolic curve or MACD or whatever it is, they give several conditions. And later on, you find those conditions are erroneously placed. And as a result, you find those charts showing various type of curves, etc. They are erroneous. And there is no one to cross-check whether it is erroneous or whether it is perfect statistical analysis. Simply you go with that of the lines on the charts and simply apply various types of lines, and according to your convenience, when the market has dropped, you pick up a curve which is showing a drop below that, so that you simply say that it is working for me. After some time, you pick up some other curve and try to place it over the chart and say this is working for me. There is no consistently profit-making system established. I am telling you from the heart that the analysts are trying their level best to find out, but they are clueless. That is why they are finding it extremely difficult to convince the trader. And most of the occasions when the people are giving calls, they hesitate giving calls. They are not free-minded. They are not very definite about their calls. Okay, that is with regard to the market trading. In the event, okay, we read the market and later on we find that the market is going against. Okay, what is the solution? The simple solution given by all the analysts is use the stop. How to use the stop? Risk reward. Take 100 pips risk and 300 pips reward. This setup. Okay, keep stop 100 pips below that of euro current level and 300 pips above you keep the buy order. I mean, above that you keep the take profit order. That is how they give it. In the event if the stop is hit first, what is the solution, or how exactly that last money of 100 pips has to be earned? No solution is given. So there can be various type of recommendations. If the traders use it and later on find that they are losing it, when they ask the analyst, then they say that no, if you have got very less equity, you cannot participate in the market. So for whom such analysis are given, it is not being defined. But invariably you come across those people attending the webinars and others are small traders. So they wanted to earn the last money because they lost the money in the market by using various techniques and they wanted to earn it. And for such small traders, if you simply say that if you invest only $1 million and try to trade in the market, you will be able to earn money. That is something like writing in a paper and giving to them. That is of no use for them. So practically you have to find out what is the solution for a small trader who will be able to really earn his living out of the market. And then you have to think about the trading strategy. whatever be the type of forecast one needs to follow, even the derived forecast algorithm what I use, which can go wrong as long as it is humanly derived, and it can go against, the market can go against that such derivations. Only when most of the occasions if the market goes against such derivations, then the derivation is useless. But if some occasions the market deviates from that of the derivations, fine. There's an error factor pertaining to that because the human limitations there in such a situation. So simply can we take 10 trades, out of that 7 trades we lose, and which happen to be the error. Then we say that 3 is to 7, it is no good. Then on the next 3 or 4 days, we might find the 7 trades are successful, 3 trades are going wrong. Okay, 7 is to 3. If you simply say such ratios and things like that, there is no consistency. Consistently, if you want to earn money, then if you simply say that 9 out of 10 trades I become successful, is it a good record? No, not at all. 9 trades you earn 10 pips, and 1 trade you lose 100 pips. Is it a profitable projection? No, not at all. So ultimately, every trade we need to earn money. For that, we need to have patience. And for that, if you use the trading strategy of using the hedging and try to find how exactly the hedge has to be, if the market hedges me, how exactly I have to come out of the hedge and try to use the hedge for either way trading, then you find that you become master in the market. If the market goes up, okay, you are earning on your buy position. If the market comes down, you earn on your hedge positions. So you should be in a position to capitalize the market moves. The market has got only 2 types of moves. The third one is simply keeping silent like this, what you come across in a holiday. Otherwise, market can either go up or come down. So if it goes up, I'll book profit in a buy position, like some buyers in the market. If it goes down, I'll book profit in the sell side, similar to that of some traders who do the sell and buy trade. So if you use the hedging, you find that consistently you will be able to build your equity. Now, we have seen that the market was making them rise and then sideways move, and this week you come across the Thanksgiving holiday. Because of that, the effective rises were not sustained. They went up. They took the market upside during certain sessions, and then subsequently they started making the slide from yesterday. And today again, because of the holiday yesterday and today, they are likely to make very subdued moves in the market. Probably a small short covering on the rise might happen during that of tomorrow. Today, US session, even though it is a holiday in US, those who have taken the positions uh, in Japan and Europe might go in for that such distress weekend closing of the positions. Now, these are all the levels in which the currencies are expected to swing. I explained it. And you find that euro came down a little bit below that of 1.06 and holding around, and they are expected, it went up only to the high of 1.0689, and a very subdued moves are seen. And in the case of GBP also, they just made a drop below that of the expected low. And in the case of yen also, that spread is very subdued. And Swiss franc again, they are making very subdued move of about 100 pips. And also in the case of Canadian dollar, about 150 pips. And Australian dollar, they just gained and slowly come up to that of 0.72 area, holding it, and they are likely to come up further. So you find that commodity pairs lead the rally and lag behind. That is what they are doing it. And in the absence of good volume, the players were handling mainly the crosses. They have been handling throughout this week, predominant of the occasions, the crosses. You would have seen that they gained quickly the levels in the case of Australian dollar and dropped euro and GBP. That is mainly to handle the commodity crosses. So that way they handle the yen crosses. When euro and GBP are dropped, USDN also they have made that drop. So now again you come across the contrarian move that USDN is showing negative net change and GBP is also showing negative net change. Both USD CAD and Australian dollar are showing positive net change. These are all the indications that in the absence of good volume, the players are making small subdued moves and handle the crosses. Now these are all the initial lows and the highs I noted down. And if you find that high and the low in the case of Euro, the high they just breached it by 2 pips. 1.0616 is the current high. The initial high was 1.0614. They wanted to slowly gain the level. And in the case of GBP, the high is 1.5106 here, and the initial 3:30 GMT high was 1.5093. 1.5093 is the low, and they just breached it by 3 pips to form 1.5090, and they are holding it below there. And 1.5106 is the high that has not been breached. And in the case of yen, 122.57 is the high. In initial low, they just breached it by 4 pips, and the high was 122.72. They are not breached it. So it indicates that they wanted to make further slide in the case of USD yen. And CHF, 1.0233 is the low, 1.0242 is the high. They already gained the level in the case of CHF, and they wanted to hold when Euro and GBP are gaining the levels. Then Canadian dollar, 1.3290 is the low, 1.3307 is the high. They just breached the high by 2 pips to 1.3309, and then they are holding there, and they are likely to come down. And Australian dollar, 1.7160. 1.7215 is the low, 1.7234 is the high. They are not breached the low or the high. So you find very subdued moves are happening in the market because of the holiday thin volume. Now the recommended trades for today, you can buy around 1.0602 in the case of Euro with 30 pips exit and 30 pips hedge order. In the event if it is hedge, wrongly typed it. Exit should be 632. The stop should be 1.0572. Then GBP 1.5094 around the current level, you can take a buy, and then they are expected to gain the levels during that of the European session and the US session slowly for the weekend. Then you can keep hedge order to limit the risk 30 pips below. So these are all the market timings. So if you got any doubt, you can ask me in the chat window. I'm willing to answer to those questions. So I'll come back on Monday, 30th of November, the last day of this particular month, and try to give the forecast for the coming week. So I take this opportunity to thank FX Trade for the facilities provided to present the webinar. And you people for your presence here. So if you have got any further questions, you can ask me through email or during that of the next webinar, watching the market moves for today, so that you will be able to really get a perfect understanding. If you follow it carefully, then you find fearless trades come in. So wish you all happy weekend, also happy trading, and see you on Monday.